All right, hello everybody, this is Mike Rixey. I am the lead options instructor at Netpicks, and this is our options trade of the week. Before we get into this week's new trade, let's go back and review the trades from the last few weeks. I've had a couple of requests from people wondering, how do we manage these positions? What do we do from here? So let's go ahead and take a look at those. Let's start out with eBay. This is the trade from last week, and we took a look at selling a call spread. We did this because the market was overbought. We're going into historically a slow time of the year. The summer months tend to be slower, lower volume, tighter range in the market. So the credit spread puts the time decay in our favor, so we make money as each day passes. It also gives us 5 ways of making money on each trade. If I were to just buy an outright call or a put, I need the market to move. It has to move quickly. It's got to make a decent size move in my favor. That's the only way I make money. So to get a little bit more conservative, we came out and we sold a call spread. Now for this position, we went out to the July monthly options. Those are the ones with 28 days left to expiration at this point. And we came out and we sold the 40-42 call spread. So let me go ahead and cue this trade up down at the bottom, and let's get an update on where things are at. We put this trade on initially last week for 61 cents. We collected $61 per spread to put the trade on. This is a neutral to bearish position. Ideally, I would love to have eBay pull back. Unfortunately, it has not done so yet. This market has continued to move higher. We made new all-time highs here this week. And as a result, eBay still extremely overbought. We have been dead wrong on direction on this trade so far. And if you take a look at the price down at the bottom, it's trading for 77 cents. We are down $16 per spread on this trade. That's the beauty of this style of trading. We can be dead wrong and we're still down less than $20 per spread. It's a very manageable position. What would I want to have happen from here? Ideally, I still want to have eBay pull back. If it doesn't, all we need eBay to do is stay below $40 per share. Right now, it's just below that level. We're just below 40 at 39.89. If price action did nothing but sit right here, I can still make money. We're down money right now, but over time, as that time decay continues to add up in our favor every single day, if price action stays right here, we're going to make money on this trade. I still love the position. I still think the market's overbought. I still think we're overdue for a pullback. So we're going to continue to hold this trade going into next week to see if we can finally get that pullback off of the high. So nothing to do here. You could still put the trade on. If you missed the trade of the week video last week, you could still put this trade on here this week if you wanted to. I'd have no issue with that. So eBay, we're still going to hold. We'll continue to keep you posted going into next week, how we're handling it, how we're going to manage it from start to finish. Going back a couple of weeks, we went to AMD, Advanced Micro Devices. We took a very similar approach here in that we wanted to sell a call spread. We wanted to sell that call spread. Again, market's very, very overbought. I wanted to get a neutral to bearish trade on, expecting the market to pull back. I didn't want to just buy an outright put because, again, I only have one way of making money in that case. I'd have to have the market make a big move to the downside, and I'd have to do so quickly. I wasn't that convinced that the timing was perfect on that trade. I was expecting the market to continue to make one more wave to the upside, potentially get choppy. So we went in and we decided to sell a call spread on AMD as well. So what we did on AMD, we went into the July 5th weekly options. These options are now down to 14 days left to expiration. And we came in and we sold the 33.5, 35 call spreads. So let me go ahead and cue this one up down at the bottom. And we'll get the strike prices correct and take a look at current pricing to see what is possible at this point. We sold the spread initially for 45 cents. We collected $45 per spread. That's the most I can make on the trade. Now, what we did earlier this week with our students, with our members, we sent out a closing trade alert. We actually closed this trade out for 13 cents, basically right where it's trading right now. So it gave us a really nice profit on the trade. Anytime that I sell a spread, I'm targeting 50 to 75% of my maximum profit potential. So whatever I collect to put this trade on, I'm going to take 50 to 75% of that number, and that gives me my target goal. So closing it out at 13 cents, that gave us right around a 75% max profit, gave us our goal. We closed it out, freed up the capital for the next trade, booked the profit. So I've had some feedback from people. Why didn't we hold the expiration to try to keep that last 13 cents of profit potential? It was going to tie up too much capital. The risk increases the closer we get to expiration. And I did not want to let this thing go from a 75% max profit to a loss if I held as we got closer to expiration. So I wanted to book the profit, and that's exactly what we did. You still have an opportunity, even though we closed the trade out earlier this week, you still have an opportunity here yet to, at the end of the week to close it out and book the profit. So AMD, nice winning trade. eBay, slightly underwater, but we're going to continue to hold it into next week, and we'll reevaluate it in next week's trade of the week. For this week's new trade, let's go ahead and take a quick look at a chart of Lyft. Now, we actually put this trade on with our students yesterday, but let me bring it over so you can see. We are overbought on Lyft. It's no surprise. We're overbought on every stock on our list almost, because this market's been on a phenomenal tear to the upside. New all-time highs hit this week. It's just been an incredible run. Well, Lyft started to show some signs of getting tired here this week. We had our pulse indicator. That is our red and yellow histogram down at the bottom. That is plotting a whole series of yellow bars. When I see that happen, I know we're in an overbought condition. We're between a 1 and a 2 standard deviation move on the upside. When I start to see that type of a situation, I know price is extended. Oftentimes when we see this type of a pattern, it's typically followed by a period of consolidation or a reversal to the downside. So we're overbought on the pulse indicator, but then also on my sentiment indicator down at the bottom, that's the green and the red histogram, we went from green to red. So we went from a bullish to a bearish mode here midweek. We then got to close below my moving averages. You can see the blue and the red moving averages there on the chart. Those are the 5-period and the 8-period exponential moving averages. We got price action to close below those levels. All of that set up a bearish outlook for me. Now, there's a couple of ways that we could have gone with this trade. I could have sold the call spread. We've talked about short call spreads here the last few weeks. But to mix it up, just to show you the flexibility that we like to take advantage of with the options, let's go back to the basics. Let's take a look at strictly buying a long put. The goal with our style of trading is a very diversified approach. And that's not just with the products that we trade. Yes, I want a mix of different stocks, different sectors. I want to have some ETFs in the mix. But I also want to layer in different expiration cycles, different types of option strategies, because the more diversification I have, the better off the growth in my equity curve will be long term. So I want to have a bearish outlook. I don't mind being a little bit more aggressive here because the market is at such a strong extreme. Because we have had no selling to speak of for the last number of weeks, I think we are due. I think we are due for some of these overbought products to move to the downside. So I want to get a little bit more aggressive. And for that, let's jump over to the trade page and switch this to Lyft. And for this strategy, I'm going to go out to the July monthly options, the July 19 options. Again, those are the ones with 28 days left to expiration. Let me go ahead and open those up. Now, I want this to be a pure bearish position. Okay, that's the goal of this trade. Again, I don't mind being more aggressive here. And I don't mind being more aggressive because I think the market's so overrun. I think we could be due for a swift pullback. So what we're going to be looking at, we actually put this trade on with our students yesterday. We're going to be looking at the 62.5 puts out in July. They're currently trading for around $2.95. Right? So you're tying up less than $300 of capital, very reasonable regardless of account size. This is going to be very different than selling a call spread. Selling a call spread gives us 5 ways of making money on the trade. It's a much more conservative type of a trade. It has a much smaller profit potential, but it also has lower risk. It's an ideal scenario for us. This, here just buying the outright put, is a far more aggressive trade. And I know that goes against what a lot of people think when trading options. A lot of people think, hey, buying calls and puts is the most conservative way to go. It's the safest way to go. In reality, it's the most aggressive route that you can go. Because if I buy a long put, yes, I know what my maximum loss is up front, but I only have one way of making money on this trade. Lyft has to make a move to the downside, and it's got to do so relatively quickly. If it takes too long, I'm going to be in trouble. Okay, so what I'm going to do, we're going to buy this 62.5 put. So all I have to do is left click on the ask price, and it's going to pop up an order down at the bottom. Right now it's trading for around $2.85. What is my profit goal on this type of a trade? On any type of a long option position, if I'm buying an option, I like to target 100% return while risking 50%. So if I'm going to pay $2.85, let's just say that's the price that I get filled at here. Well, if I want to create a closing order right away, I'm going to target $5.70. That would give me right? That would give me 100% return on my capital. That's my initial target. My risk is 50%. So I'm going to set a closing order at $1.42 or so, give or take a few pennies, just depending on where you get filled at. So now we've already built in a 2-to-1 reward to risk. If I can hit full target, great, I'll double my money. If I am dead wrong on this trade, I'm out 50%. We're starting to stack the deck in our favor. Doesn't mean we're going to win on every trade, but we don't have to. Yes, I want to have a good winning percentage long term, but because my winners are larger than my losers, it takes an incredible amount of pressure off my winning percentage. I don't need to win 80, 90% of the time. It's not necessary. It's great that we do have a positive winning percentage over time. It's good that our winners are larger than our losers because that's the formula that's going to give you successful results over time. So we'll go ahead, we'll track this one over the next couple of weeks. We'll see what happens. I'll keep you posted. We'll take a closer look at eBay next week. We'll keep a close eye on Lyft, and then we'll take a look at our new trade next week, towards the end of the week as well. If you have any questions between now and then, feel free to post a comment here in the YouTube video. You can post a comment inside of our blog or send me an email directly. Mike@netpicks.com is the email address. So I'm going to wrap this video up here. Enjoy your weekend, everybody. We'll come back with you next week with our next trade of the week.